There's this American company. It's only around 35 years old, but it's outrageously powerful. Think about the entire economy of Japan, about $4.2 trillion. Now, add the entire economy of Germany, about $4.4 trillion. Combine all of that ... and you still won't get to the $10 trillion in assets managed by this one company. Look, when you think about global power, the first names that come to mind are the White House or the Federal Reserve, or maybe the big banks like Goldman Sachs or J.P. Morgan, right? It's rare for us to think about this quiet asset manager called BlackRock. I mean, they're the world's largest shareholder. They own a piece of Apple, Microsoft, Amazon, ... Basically, a piece of everything you buy. And they built an AI that basically runs the entire global financial system. This company is still around, by the way, so buckle in. Today, we're going to get into the bizarre story of BlackRock and its founder, Larry Fink. Let me take you back to 1986. Larry Fink is a 34-year-old star trader at a bank called First Boston. He's a pioneer in a new market, mortgage-backed securities. He's making his firm millions. Then, in one quarter, interest rates shift. His models fail, and he loses $100 million. In an instant, his career is over. That failure taught him one thing. Nobody on Wall Street really understood risk. The banks were all flying blind. Fink knew he couldn't just build a better bank. So he built a new kind of weapon. Not private capital, but risk analysis. In 1988, Fink and 7 partners convinced the private equity firm Blackstone to give them a $5 million line of credit they called their new venture BlackRock. On the surface, it just looked like some other investment firm, right? But under the decks, it was a machine of economic surveillance. They weren't stock pickers trying to beat the market. They were risk managers using new computer power to protect their clients' money. And their clients weren't regular people. They were pension funds, insurance, companies, and college endowments. This was no longer wealth tied to just making trades. This was wealth manufactured at scale by knowing the risk of every trade in the world. Now, the traders were operating the business. They drew the blueprints. But someone else was keeping the foundation of this company standing. That was Larry Fink. You see, across Wall Street, the old guard, the masters of the universe, watched all this unfold. Fink wasn't like them. His $100 million failure had humbled him. He wasn't interested in fame or big, risky bets. He was obsessed with one thing: predicting the future. By the way, please do support the channel by liking and subscribing. Help us get to 100,000. We're so close. Anyway, as I was saying, Fink faced a choice: fade into irrelevance or adapt. He couldn't rely on the old ways of trading. He used the only thing he had left: capital and technology. You see, Fink didn't just want to manage money. He wanted to build a central nervous system for finance. A platform that could see everything, everywhere, all at once. He called it Aladdin. That stands for Asset, Liability, and Debt and Derivative Investment Network. Aladdin was the real product. It wasn't just a program. It was a network of 5,000 mainframe computers running 24/7, modeling thousands of risk factors. What happens if oil hits $150? What happens if a cargo ship gets stuck in the Suez Canal? Aladdin would have the answer. This system, this Aladdin, became the shadow power behind BlackRock's rise. The company expanded, but it wasn't a true giant yet. The move that changed everything came in 2008. The financial system is collapsing. Lehman Brothers is bankrupt. AIG is next. The U.S. Federal Reserve has to stop the bleeding. But the Fed has a problem. It doesn't know what all this toxic mortgage junk is worth. The banks that created it. Their models were wrong. So who did the U.S. government call? They didn't call Goldman Sachs. They didn't call J.P. Morgan. They called Larry Fink. BlackRock didn't behave like a business. It moved like a sovereign. I mean, that was the whole point. The government hired BlackRock, with no competitive bid, to analyze and unwind the toxic assets from Bear Stearns and Egg. They weren't just another company. They were an imperial state in their own right, the only ones with the technology to do the job. And at its peak, BlackRock's AI, Aladdin, wasn't just managing BlackRock's $10 trillion. It was licensed out. Today, it sees over $21.6 trillion. Just for comparison, the entire GDP of the United States is $27 trillion. This one AI platform monitors a sum of money nearly the size of the entire U.S. economy. But none of this scale happened in isolation. You see, the success of BlackRock stood on three pillars. 1. The 2008 crisis, which made them the government's go-to fixer. 2. Their technology, Aladdin, which none of their rivals could match. And 3. A $13.5 billion deal in 2009 in the middle of the crisis. BlackRock bought a division from Barclays Bank called iShares. iShares didn't pick stocks. It sold ETFs, or exchange-traded funds. This is where something innovative happens. Instead of paying a manager 2% to maybe beat the market, you could buy an iShare ETF, like IVV, and for a fee of just 0.03%, you owned a tiny piece of all 500 companies in the S&P 500. It was cheap, it was simple, and it was passive. Money flooded in. This created a new kind of power. Because BlackRock was passively buying all the stocks, they accidentally became the largest shareholder in, well, almost everyone. Today, BlackRock, along with its two passive rivals Vanguard and State Street, are called the Big Three. Together, they are the single largest shareholder in 90% of S&P 500 companies. They are the top shareholders in Apple, and in Microsoft, in Amazon, and in Google. They are the top shareholders in Pfizer ... and its competitor, Johnson & Johnson. They are the top shareholders in Coca-Cola ... and its competitor, Pepsi. This wasn't just a business. This was a concentration of ownership the world had never seen before. What's wild is that this financial influence didn't just stay on Wall Street. It quickly crossed the border into Washington, D.C. This was carried by ideas, institutions, and one man, particular Larry Fink. You see, Fink's early role brought him into the orbit of politicians and regulators. But his true impact came much later. In 2018, he published his annual Letter to CEOs, and it didn't just talk about profit. It talked about purpose. Fink announced BlackRock would use its $10 trillion in voting power to push for ESG, environmental, social, and governance. He told CEOs that if they didn't take things like climate change seriously, BlackRock would vote to fire their boards. This wasn't just a political reshuffling. It was a financial revolution at its core. One man, running an asset manager, was now setting global social policy for hundreds of the world's biggest companies. And then there's the revolving door. In 2020, the COVID pandemic hits. The Fed needs to launch another, even bigger rescue. And who do they hire, again, to manage it? BlackRock. At the same time, a former BlackRock executive named Brian Dees was tapped to become President Biden's top economic advisor. Dozens of BlackRock officials have served in the Treasury and Federal Reserve, and vice versa. This has led critics to call BlackRock the fourth branch of government. They help write the new rules. They get paid by the government to execute the rescue plans. And their own $10 trillion portfolio benefits from the stability those plans create. So it's quite clear that BlackRock is revolutionary. It transformed investing, corporate, finance, and state power forever. But even a giant has limits. By the 2020s, cracks had begun to show. Now look, This video focused a lot on the financial innovations of BlackRock. But it's very important that we talk about the dark side of this concentration of power. This includes the ESG debate, conflicts of interest, and the risk of herd behavior. Let's just talk about a few examples here. First, the ESG backlash. Critics on the left say it's greenwashing, pointing out BlackRock is still one of the world's largest investors in fossil fuels. Critics on the right call it woke capitalism, and are furious that a financial firm is pushing a political agenda. The state of Texas pulled $8.5 billion from BlackRock in protest. Florida pulled $2 billion. Then you have the Aladdin problem. BlackRock doesn't just use Aladdin for itself. It leases it to its competitors. Vanguard uses it. Apple uses it. The Japanese government's $1.5 trillion pension fund runs on it. This means hundreds of different companies are all using the same AI to see risk. If Aladdin's model has a blind spot, the entire global system has that same blind spot. It's a concentration of risk that makes the 2008 banks look small. So yeah, they contributed a lot to modern finance. Lots of good stuff. But it's important to keep things in perspective, right? From observing the rise of BlackRock from that $100 million failure, we can clearly see a pattern emerging. And that is, power and capital are always inseparable. Larry Fink realized pretty early on that information about risk could be more potent than a bank charter. They transformed risk into a corporate-state hybrid, and they scaled that model across decades and continents. They left a legacy that defines how the world governs money today. So that brings us to a question that still matters very much today. If one company's AI now holds the power that was once reserved for the entire market, then the question is, who governs that AI? Is BlackRock the essential firewall preventing the next 2008? Or is it the single point of failure that will cause it? If you are so far, please do leave an emoji of for Aladdin in the comments. And if you like this channel, please do subscribe to it. I'm hoping to reach 100,000, and I could really use your help. Thanks so much for watching, and I'll see you soon. Script END